Hi Digital Chiefs. Today I thought I'd talk through something really interesting that I saw on my LinkedIn feed a little while ago. Some of you might already know him really well if you're based in Asia Pacific. His name is Rayn Ong, or otherwise known as Make It Rain. He's an angel investor, an investor in the Blackbird Fund, and I believe now he also runs his own fund. If you check out his LinkedIn, he's got a huge number of exits, a really well-known Australian investor. The link for his profile, if you want to connect with him, I'll provide that in the description. Now, this post included a link to a fictional ebook named Australian VCs Are So Dumb, Memoirs of a Dumb VC. I completely missed the word fictional in the original reading, so there is no actual ebook, it's an ongoing joke. Now let's go back to Rayn's post. Why do VCs say no to you? Number one, I don't have the money. I could still be raising my fund, or my big investor suddenly can't pay their capital call. I'll go over capital calls and the structure of VC funds in a future video, but basically VC funds are normally a pool of investors they have raised money from, and the investors don't put in all the money in the one go. Some smaller funds might, but most funds will call or request the funds on a routine basis. So that might be quarterly, half yearly. Some will have a 2-week notice period when they are about to make an investment and they make calls for the funds. However, say if there is a black swan event, the share market crashes or COVID hits, could be anything really, and the LP investor doesn't have the cash on hand, then the money they have promised to the VC fund can't actually make the startup investments. So yes, even though a headline will say that they have raised X amount for their fund, it doesn't mean all of this is in the bank right now for that venture capital fund. And there's not a lot the VC fund managers can do about it either, given it would cost more time and money to sue the LP investor for the fund. I know venture capital is weird. Again, I'll go into more detail about all of this and the structure of VC funds in future videos. Number two, your pitch deck is bad. You use 9-point font, black text on red background, and you animate every single slide. Most decision makers are over 40 and their eyesights are shit. If I can't read it, it is safer to say no. This is so true. On top of this, being Asian, I was told that genetically our eye shapes are not developed for 20/20 vision. So there you go, my Asian friends watching. Now, where the heck have I left my glasses? Jokes aside, see my video on ways to instantly improve your pitch deck and fix these basic mistakes. Number three, you insist on pitching me in person. I get 500 pitch decks a day. I can't even read them all. I've actually said this several times myself in my videos, but it's not just investors. I don't think there's anyone out there saying, yes, please send me more emails. Investors are paid when they find the right companies, the right deal terms, and eventually when there is a big exit event. Conservatively, they don't invest in 95% of pitches. And as Rayn said, most of us can't even read them all. We spend 60 seconds or less to initially skim the deck, and if there's enough there, we might go over it again more slowly and then ask for a meeting. That's if the deck is opened at all. If your cold email or your connector warm intro is bad, it just gets deleted. Here's a link to some videos on cold emails and the best and worst pitch decks you can learn from. How could I do 500 coffees a day? What would all the caffeine do to my skin? If you can't think from my angle, I doubt you can understand your customers. I love this part. Your skin will look pretty bad, Rayn, because you won't be sleeping. And don't get me started with the NDAs. Another classic one, I did a video on this also, why investors hate NDAs. Check out the link for more info on that topic, including reasons why they're mostly useless and unenforceable anyway. Number 4, you tell the wrong story. You spend 6 slides on the problem space when I am most interested in how to make 100x my money. This is a key point I continue to emphasize with founders. The definition of an investor is to make money, but somehow that is lost on founders when they're pitching for investment. If you're not showing us how we can make money, and the faster the better, then it's in the too hard basket. Number 5, there is a hotter deal out there. The faster they can return the most money to their investors, the faster they can go out and raise their next fund. This is why it's important to show momentum in your startup pitch. If it's not moving quickly and making money, which translates to an increase in valuation and ROI for the investor, then they are already looking over your shoulder, and you can bet they are chasing the fast moving startups and deals instead of you being the one chasing them. How much money and how long do you need to make the first 1 million in revenue? If there are more compelling stories also raising money out there, I'm gonna say no to you. It's not you, it's them. An important underline here, compelling stories. This is why a one-size-fits-all pitch deck doesn't work. You need to find your story, and each founder startup story has compelling parts, and most startup founders are bad at selling it. So this is where you might need some coaching and support. Number 6, you are raising too much. I write 400K checks. You want a 5 million USD angel round. This is about vetting your investor, making sure you're a match. For a round, you generally don't want more than about 5 investors. Find out how much money they invest typically, and does the numbers make sense? It could be too much or too little, i.e. they write big checks but you're only raising 250K, or they do Series A onwards and you're raising a seed round. Valuations are also important here. If your numbers mean your investor is too diluted, i.e. they own less than 5 to 33%, then you need to relook at your numbers. Number 7, you are outside of my comfort zone. There are certain verticals and business models I have no interest in. Do you want me to say no upfront, or spend 6 months to do due diligence and still can't get comfortable? Again, this is about understanding your investor. I get a lot of fashion and beauty businesses in my inbox. Because I'm female, it's assumed it will be of interest to me. But I pretty much only do B2B SaaS, and ideally with some sort of social impact that relates to clean air, water, financial literacy, or property, where a lot of my network and background is. I can't seem to get too excited about anything else. Know what the fund and investors' taste or theme is, and again, how early or late they like to invest, which relates back to their typical check size. Number 8, you don't fit my mold. VC is a high-risk career path. I need to choose what I invest carefully based on my timeline, not yours. If I cannot produce good outcomes and raise my next fund, that's the end of my VC career. What am I going to do next when that happens? Sell overpriced ebooks? The truth is, 50% of VC funds haven't done 1x, i.e. don't produce even a return on the initial capital invested for the fund. Only 1 in 50 do a 5. That's pretty abysmal numbers. Those watching from the outside assume it's a fast track to getting rich. But the fact is, as 90% of your startup bets fail to deliver any sizable return for your fund, you spend most of your time mentoring, connecting, working with a startup to only have 90% of the effort go down the drain. It's not for everyone, and hence alignment of values between investors and founders is crucial for when times get tough, and they will at some point in the 5 to 10 year journey to exit. Number 9, not active. This is an additional point for VCs and investors overall, and the reason Rayn probably didn't cover it is because it doesn't apply to him. There are times when an investor is not active, i.e. an angel investor who might already have a full portfolio and filled their quota. Generally speaking, it's recommended with a balanced investment portfolio that 10% is in diversified high-risk investment ventures such as venture capital. So it might be the case that that investor has filled their 10% quota. Or the VC fund, as Rayn mentioned, is fully deployed and they might be raising their next fund. There could be other reasons or something internal happened with changes in the partners. It could be that the fund is close to being fully deployed, and given the timeline of active investing is anywhere from 2 to 7 years, you could be at the end of their timeline and they are only looking at later stage companies, as that will be a shorter timeline for them to exit and get a return on their investment. Perhaps they don't lead rounds and you don't have a lead investor yet. Or they say they invest in women, but really it's only a headline and they don't do any reporting of their investing stats, nor will they accept cold emails. That means there could be a host of different reasons around the investor that is outside of your control. So be smart about it and vet your investor also, or better yet, work out how to get as far as you can without external capital and come back into the market when you've ticked a few more boxes. Thank you, Rayn, for sharing your insights in this post and for letting me add my own thoughts. Next up, check out this winning pitch so you can have more investors saying yes instead.